Here's the enriched, high-value expansion of the provided content. 25. Consignment, third party, and IPO. This section covers non-standard fulfillment models cases, where ownership, logistics, or procurement do not follow the normal sell-from-stock model. These scenarios are common in real projects and are frequent interview traps, because many consultants understand them only transactionally, which T-code to use, not conceptually, what happens to the money and the liability. The core distinction: in a standard sale, possession and ownership transfer simultaneously when the truck leaves the plant. In these special scenarios, possession and ownership are decoupled. Senior SD consultants understand who owns the stock. Balance sheet: who holds the stock. Logistics: when is revenue recognized. P&L: consignment. Definition: greater than stock is placed at the customer's location, but ownership remains with the company until the customer actually consumes it. Why business loves it: customer service, the customer has instant gratification, the part is already on their shelf. Reduced lead time, zero waiting time for the customer. Lock-in: if your stock is already filling their warehouse, competitors can't get in. Why operations hates it: inventory visibility, it is ghost inventory. We own it, but we can't see it or count it easily. Risk: if the customer's warehouse burns down, our assets are lost. Scenario and usage. Typical industries: automotive, spare parts at a dealer. Healthcare, implants, screws or plates, in a hospital. The surgeon opens the box during surgery, that is the moment of sale. Retail, vendor-managed inventory, VMI, in supermarkets. Key business idea: billing is deferred. We ship today, but we might bill next month or next year. Price validity: usually the price is determined at the time of issue, consumption, not at the time of fill-up. This protects the vendor from inflation. Phase 1. Consignment fill-up. KB. Purpose: move stock from the company plant to the customer's location. Special stock. Process and configuration. Sales order type: KB, consignment fill-up. Item category: KBN, consignment fill-up. Schedule line category: E1. Movement type: 631, transfer posting, plant stock, customer consignment stock. Financial impact: crucial. No invoice, you cannot bill this order. No revenue, no sale has occurred. Accounting entry: none, usually. Or purely a reclassification within inventory accounts. The stock moves from unrestricted use to customer consignment, W. Senior insight: greater than consignment fill-up is not a sale. If you trigger an invoice here, you have committed tax fraud because no transfer of title has occurred. Phase 2. Consignment issue, KE. Purpose: the customer reports, I used 5 widgets today. We now record the sale. Process and configuration. Sales order type: KE, consignment issue. Item category: KEN, consignment issue. Schedule line category: C0 or C1. Movement type: 633. Issue from customer consignment stock. Financial impact: ownership transfers, now. Billing triggered: this creates the commercial invoice. Cost of goods sold, COGS. Recognize now. Revenue, recognize now. Senior insight: greater than this is the real sale. Greater than. Greater than, in high-volume setups, example. Hospitals. This process is often automated via IDOC interfaces, where the customer system sends a consumption report daily, and SAP auto-generates the KE orders. Phase 3. Consignment pickup, KA. Purpose: the company decides to retrieve stock because it is slow-moving or the contract is ending. Process and configuration. Sales order type: KA, consignment pickup. Item category: KAN. Movement type: 632. Customer consignment stock, plant stock. Characteristics: logistics only, we are just bringing our own property back home. No credit memo, since we never billed the customer for fill-up, we don't owe them money for pickup. Phase 4. Consignment return, KR, purpose: the customer consumed the item, issue. Was billed, but the item was defective, so they return it. Process and configuration. Sales order type, KR, consignment return. Item category, KRN. Movement type, 634. Characteristics. Credit memo. Yes, because they were previously billed, in the issue phase. Stock destination. It returns to consignment stock, at customer. Not plant stock immediately. This is a subtle but critical distinction. Senior insight on consignment. The moving average price trap. Since the stock sits at the customer site for months, the value of the material in your system might change. Question. When we bill, do we use the cost from when we shipped it or today? Answer. Standard SAP uses the current valuation. This can cause margin variance if costs have spiked. Golden rule. Greater than billing defines the sale, not the delivery. Greater than. Greater than in consignment. Delivery happens in phase 1, billing happens in phase 2. They are completely separated by time. Third-party sales, TAS. Definition. Greater than the company sells goods it does not possess. We take the order, but we hire a vendor to ship directly to the customer. Goods move, vendor-customer. Invoice flows, vendor-company-customer. Common in, trading companies, brokers who hold no inventory. Dropshipping, e-commerce models. Service models, subcontracting specific tasks. Process flow, the triangle. 1. Sales order, SO. Customer orders 10 units. System sees item category TAS. 2. Purchase requisition, PR. Automatically generated by the SO schedule line CS. 3. Purchase order, PO. Purchasing team converts PR to PO and sends to vendor. Critical. The delivery address in the PO is the customer's address, not our plant. 4. Vendor delivery. Vendor ships goods to customer. 5. Statistical goods receipt, optional. We record a fake GR to update the system cost, even though we never touched the box. 6. Vendor invoice, Miro. Vendor bills us. 7. Customer billing, VF01. We bill the customer. Configuration and control. Item category, TAS. Billing relevance, F. Order-related billing status according to invoice quantity. Meaning, you cannot bill the customer until you have received the invoice from the vendor. This ensures you don't sell something the vendor hasn't confirmed shipping. Schedule line category, CS. Order type, NB, standard PO. Item category, 5, third party. ACCT assignment, 1, third party. Costs post directly to COGS, not inventory. Scenario A, without shipping notification. Trigger, we assume the vendor shipped it. Billing, we bill the customer as soon as we pay the vendor, Miro. Risk, we might bill the customer before they receive the goods. Scenario B, with shipping notification, ASN. Trigger, vendor sends an ASN, shipping notification. Control, higher accuracy. We know exactly when the goods left the vendor. Third-party returns. This is messy. Flow, customer, vendor. System, we create a return order, credit memo. Simultaneously, we need a credit memo from the vendor. Challenge, ensuring the vendor actually received the return before we credit the customer. Senior insight on third party. The statistical GR debate, pure trading. You don't want a GR. You just want AP, accounts payable, and AR, accounts receivable. Control freak, you force a statistical GR just to verify the transaction steps. Critical understanding, SD controls commercial flow, MM controls procurement. Physical stock never hits your inventory GL. It goes straight to COGS. Individual purchase order, IPO. Definition, greater than make to order for trading. Each sales order requires a unique procurement, but unlike third party, the goods come to us first. Used when we need to inspect the goods. We need to repackage or label the goods. We need to combine it with other items from our stock before shipping. IPO process flow. 1. Sales order, item category TAB. 2. Purchase requisition, generated for that specific sales order line item. 3. Purchase order, Sent to vendor. Delivery address equals our plant. 4. Goods receipt, GR. Goods arrive at our dock. They are placed in sales order stock, special stock E. They are reserved for this customer. 5. Delivery, VL01N. We pick, pack, and ship to customer. 6. Billing, F2. Delivery-related billing. IPO configuration. Item category, TAB, individual purchase order. Schedule line, CB. Valuation, the stock is often valued separately, valuation type, because the purchase price might vary wildly per order. Key difference from standard stock, you cannot use IPO stock for another customer. It is hard allocated to the specific sales order. Comparison, critical for interviews. Feature consignment third party, TAS. IPO TAB. Stock ownership company, until issue. Vendor, until delivery, company, briefly. Physical flow company, customer. Storage, vendor, customer, vendor, company, customer. Billing trigger consumption. Issue, vendor invoice. Miro, outbound delivery, PGI. Inventory GL, yes. Special stock W, no. Direct to expense, yes. Special stock E. Delivery creation, yes. Fill up or issue, no. Usually, yes. Primary risk ghost inventory at customer delivery reliability dead stock. If order canceled. Common real project failures. 1. Billing during consignment fill-up. The finance team sees a delivery and tries to bill it. The system must be configured to block this, not relevant for billing. 2. Third-party billing prematurely. Billing the customer before the vendor has shipped. The customer gets an invoice but no goods. 3. IPO dead stock. Customer cancels the order after we bought the goods. Now we are stuck with a custom item in special stock E that we can't sell to anyone else. 4. Wrong valuation, in consignment. If the price changes in the material master, the issue might post at a different cost than the fill-up, creating unexplained variances in the GL. How senior consultants think. They act as detectives for liability and timing. They always ask, 1. Who holds the risk? If the truck crashes, who loses money? 2. Who delivers physically? Do we need a pick list? 3. When does the accountant smile? When is revenue recognized? If you answer these 3, the SAP configuration, item categories, schedule lines, becomes obvious logic, not just memorization. Mental model to lock in. Consignment equals stock is forward-deployed. My stuff, your house. Third party equals pass-through commercials. Your stuff, his house, my invoice. IPO equals pass-through logistics. Your stuff, my house, or labeling his house. Final perspective. These scenarios exist because business reality is not always sell from warehouse. Consignment builds trust and stickiness. Third party allows infinite catalog expansion without capital investment. IPO allows quality control on outsourced goods. Senior SD consultants master these because they enable the business to say yes to complex customer demands without breaking the financial backbone of the company. Misunderstanding them causes serious audit risks, revenue recognition errors. Say next when ready.